Welcome back to the channel. So this right here is a chart of the S&P 500, and as you can see, there has been a lot of sideways movement in the S&P 500 since about July 2022. Now there are lots of reasons for this, but one of the big concerns is the fact that there has been a recessionary fears for the last 12 months, I would argue. And so the question in this video is, how do you invest in a recession if you're a beginner or a novice investor? Well, I'm going to give you some thoughts, some tips, a few things to think about, which hopefully will inspire your next steps. Now, we don't need to go over the dictionary definition of what a recession is, but I do think we need to talk about a recession and recessions as a topic and how they intersect with the topic at hand being investing. Because if you are indeed a beginner or a novice, you may have come across content online, either here on YouTube or Instagram or TikTok, which will promise you the world of how you can be rich very, very quickly when you invest money. And nothing is further than the truth from that, really, to be honest. There is a lot of risk when you invest into the markets, or when you go on your journey of investing. Your capital is at risk. And unfortunately, a recession comes alongside good times in the markets. It's the flip side of good performance, right? And when you look through history from 1973 to the present day, there have been 6 major recessions. The last one back in 2007 basically saw the S&P 500 drop by about 58%. Now, thankfully, we are in a better place than we were back then in 2007. And the reasons why we're facing a recession now are not the same as they were back then. But if you don't know about 2007 and you want to be entertained, I would strongly recommend you go watch this film, The Big Short. It's an amazing film, and it tells the story perfectly of the subprime market, the subprime mortgage market, I should say, and how the recession in 2007 and 2008 came about. It's got an amazing cast. It's one of my favorite films. And this really brings me on to the first thing that I want to talk about in this video, and that is the issue. The issue that you cannot avoid when you start to have this conversation about investing during a recession. But before we do this, a lot of the stuff that I'm going to talk about in this video is about knowledge and information. I have 15 years experience in financial services. I have 8 within wealth management. I'm a qualified financial advisor. And so a lot of stuff that I know I've gained because of my job. You watching this may not be in a career or in a job where it is your job to know what I know. And therefore education becomes so important. And that's why in this video, I partnered with IG, who have the IG Academy, and it is a great place with a plethora of free online courses that you can take to help you gain the knowledge of how to make investing decisions from a place of, I guess, knowing and understanding rather than guessing. And this is really, really important because there's already a risk when you're investing. You want to be sure that you're making the right decision. The saying that I often use with this is that, would you rather have someone take you out, teach you how to fish, or fish on your behalf? Now, I will leave a link down below to the IG Academy. You can join. It's completely free, and enjoy some of the free courses that they have available there so that you can gain the education and the knowledge, the foundation that you need to make the best investment decisions for you. Now, the issue with investing during a recession is that it is a double-edged sword. It is a two-sided coin. On one side, there is an increased risk to your capital. So during a recession, as we've already alluded to, the fact that the economy isn't performing as well, and therefore the companies within this economy who are listed on the S&P 500 or the FTSE 250 or the FTSE 100 may not necessarily perform as well as they used to before. That can impact their profitability, which will impact their share price. And if you've invested in these companies, when the share price falls, it is likely that you're also going to see the investment value, or the amount that you invested, also fall, which could lead to a potential loss. So that's the risk that on one side of the coin. But on the other side of the coin, you also have potential opportunity. And when you think about some of the biggest investors, the most popular investors the world over, the likes of Warren Buffett, Charlie Munger, the likes of Peter Lynch, people like that look forward to recessions. Why? Because, well, they see it as an opportunity to buy companies that are integral to the way we live our lives at a discount. So in said economy that may be in the minus, that is faltering, companies aren't performing as well, their profitability has been hit, their share price comes down, they can buy it at a lower price, knowing that this company is integral to the way we live our lives, is a strong company, has been around for a very long time, has a brand, has a reputation, and will recover after this recessionary period is over. And there is no guarantee that you're going to get this right 100% of the time, but that is the premise that they work upon. Saying that is one of those beautiful things that you can always look back on in hindsight. You can always go back over the history logs and see the performance of a group of companies at any given time. The difficult thing that I've learned, certainly as a retail investor myself, and certainly advising people, is that making the decision in the moment right now, if you're trying to do this on your own, is really, really difficult. And sometimes you second guess yourself. And so what we're going to do next is we're going to have a look at some examples of companies. What kind of companies can we look at who have performed pretty well historically in previous recessions? And these won't be silver bullets, right? These are not going to be companies that you should go and buy tomorrow because I say so on this video. Absolutely not. You still need to do further research. And on the research, there are different ways in which you can research. In this video right here, spoke with a technical analyst at IG, and we spoke about the different kinds of research you can do. So go and watch this video. I'll put a card to it above as well for your further research. But what I'm trying to say here is, look, there's a lot more to it than just looking back over history to find out what kind of companies, but I'm going to give you some examples, and hopefully that's a jumping off point for further research for you. To really get your head around what I'm about to cover with you, I think it's really important to understand what investing is all about. Now, I cover this in my book under the Invest Early part of my basic formula. Now, investing is all about buying shares, being an owner, a part owner in companies that provide products and services that are integral to the way that we live our lives as a species, as human beings. And in taking ownership in those companies, as those companies grow, the hope is that you will also grow and make money alongside them as well. That's the basic premise of investing. And consumer staples is a prime example of products and services that we absolutely need. And when you really think about it, what do we need? We all need food. Well, this is what consumer staples is all about. It's about food and beverages. Now, think about some of the biggest companies on the planet that operate within that arena. Straight off the bat, I can think of Coca-Cola. And I'm actually, in the video that I signposted a little bit earlier on, we actually did a conversation with the IG analyst talking about Coca-Cola and Pepsi specifically. So again, go watch this video right here. I will leave a card up above as well for you to link to it. But these are companies that are prime examples of businesses that we need. Coca-Cola is one of them. You also have Procter & Gamble as another example, or Johnson & Johnson. They provide products and services that are important to us. Now, speaking about Coca-Cola specifically, check out this chart of the performance and trajectory of the Coca-Cola brand. Now, I'm being quite mindful in this, in the fact that I'm showing you a graph which is looking back over the past 10 years. And again, past performance is no indication to future performance, but it's interesting looking at this graph. Now, what you will notice is that you will notice that in 2020, there was a steep drop in the performance of Coca-Cola and its share price. Now, that is down to the fact that lockdown, everything was shut down, so most companies were no longer operating, and Coca-Cola is no exception to that. But one of the key things that you're looking for when you're invested in the company is its bounce back ability, the ability for it to recover. And what you're seeing here is actually the recovery in that share price since 2020 is actually quite good, and it's back over the peak that it saw in 2020 just before that sharp drop, which is a really encouraging sign for a company like this. But again, we're just looking at this from a very, very high level. You need to do more analysis and more research to find out whether this is a good fit for you as an investor. And again, this is where the IG Academy can help you gain the information that you absolutely need. Another couple of examples in this food and beverage arena are the likes of McDonald's and KFC. Now, McDonald's is a standalone company on the stock market. You can see their performance here. And actually, McDonald's have performed pretty well. I mean, even through 2020, yes, you saw a bit of a dip in the graph right here, but it's performed pretty well since then. And that's because people still need to eat. Now, we don't live in a perfect society. Many people will argue that McDonald's isn't the healthiest food, but the reality is that they provide a cheap meal when it is needed. And in recessionary periods where people are looking to reduce their spending and they're tightening their belts, companies like this are going to do very, very well. Another example of this would be the Yum brand, which they own a KFC and Pizza Hut. So in 2020, you see a bit of a dip, but just like McDonald's, you see that they've actually performed pretty well over the last 3 years. Now, again, past performance is not an indication to future performance, but this is just an example of a group of companies that have performed well and have performed well historically when it comes to recessionary periods. And again, this may give you some food for thought of the type of companies to go and have a look at. Now, other sectors that you could potentially have a look at that have performed historically during recessionary periods are utilities. Now, we all know the story of Royal Dutch Shell, BP, Centrica making a ton of profits during the cost of living crisis because of the energy price spikes. Well, that sucks as a consumer, but as an investor, you're laughing because you would have benefited from the share price increase. You also would have benefited from dividend payments and possible share buybacks as well. So again, we need energy, we need gas, we need electric. So that is another sector that you could potentially have a look at as an option. You could also have a look at companies within the debt recovery space as well, because as people struggle to make ends meet, those kind of companies tend to see an uptick in activity, more customer base, so on and so forth. Equally, financials, banks, credit card providers, those providers become very, 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 very popular during recessionary periods because people may be strapped for cash and people may need to utilize credit to be able to tie them over for a period of time. You know, there are lots and lots of examples of companies, groups of companies that work within different sectors that potentially do well during recessions. But again, you have to make sure that you're researching all of this information to make sure that they are the right kind of companies that you want to invest in and you're confident in the decision that you're making. So look, let me know what you think of this. Are there any sectors that you can think of that I've not mentioned in this video that have historically done well or you would expect to do well in a recession? Any services, any products that you see or think have done really, really well? I'd love to have a discussion with you in the comment section, so leave that there. But I hope that you found this useful, hope that you found this entertaining. Again, make sure that you visit the link to the IG Academy in the description box down below. Until next time, catch you later on.